It's that time of the market phase again, right? We have touched all-time highs. If you're tracking the equity market, Nifty, Sensex, broader indices like that is touching all-time highs as we speak. It's a good thing if you are an investor in equity market. Your portfolios will definitely be doing well. I'll be surprised if you're not generating double-digit returns at this point if you're investing for the last few years. However, it also brings concern in some investors' mind. They start getting a little jittery. They're like, oh, markets are at all-time high. Will it crash from here? Should I just exit all my equity investments? Should I just go and sell and park in debt, wait for the market to crash and then invest it again? I have been in the markets for more than 20 years now, and I've heard this multiple times being asked. Many investors kind of want to time the market. What they're trying to do here is, markets are at all-time high. Let's exit equity. Let's wait for it to fall. Let's re-enter when the markets have fallen and earn extra returns over a period of time. I hope you understand it is easier said than done, because no one really knows when the market will crash, till when will it crash to, when is the right time to buy, and so on and so forth. So we have always said this to investors and anybody we meet, literally, do not try to time the market. Stay invested, keep on investing regularly in equity, and then over a period of time, the compounding will take over. Let me present some data as to why I'm saying so. Let's assume that there is someone, let's call him, let's say, Mr. Curious. Now, this Mr. Curious is a very curious person. He only invests in the market when the market touches all-time high. He will never invest on other days. He will wait for the index to touch all-time high levels till then, and then he will put some money on that day. Now, intuitively, one might imagine that this is a very foolish strategy. You are investing at the highest point of the market till then. I'll give you an example. If you consider, let's say, 2008, at that point, markets touched an all-time high before it crashed again. At that point, the all-time high was close to 6,274 on Nifty. So I'm talking about this Mr. Curious who has this simple vision in life. Whenever the market touches all-time high, I'll invest some money. And this person, let's say, has done that every time the market has touched all-time high. Now, please understand, market touches all-time high once. It may correct over a period of time. It will again come back, cross the previous high, and then go to one more new high, right? So the first investment was done when the market was high. The second investment was done when the market crossed that high, and so on and so forth. So if you imagine, currently we are close to 19,500 on Nifty, which is a new high. So Mr. Curious has invested right from 2008, every time when the market has touched a new high, and kept on investing like this. Now, if you imagine, there is no time periodicity to this, because you don't know when the market will touch a new high. This person has, let's say, invested only at the highs. Do you know what kind of returns this investor has made over this 15 years time frame? The compounded annualized growth rate for his Nifty investment is a little over 10.5%, which I would say is not bad at all, because it is still double digit. It is still more than most other asset classes. So if you're thinking about it, even if you invest at all-time highs consistently over a period of time, because as a country we are growing, all-time highs are also getting breached. So what is 19,500 now will look very, very low if in few years we will see 50,000 on the Nifty, for example, right? So you essentially are ignoring the timing. You're riding the bull wave over a period of time and investing in the market. I'll give you a few more statistics. Let's assume you are talking about someone, let's call this person Miss Unlucky. Now, this person is so unlucky that every time this person invests in the market in any given point during the year, that is the 52-week high. So you're investing at the 52-week high, which is the yearly high of the market every year. So you're coming to the market once a year, investing the money at 52-week high, and then exiting. When I say exiting, not investing again. Next year again, you will come 52-week high, you're investing and not doing anything. Over the last 25 years of data, if you see, even if you invested 52 weeks high, every time you invested that was the high of the year, your IRR or compounded annualized growth rate is about 11.2%. Not bad at all, because again it is beating inflation. 11% is a very good rate of return from equity for someone who's so unlucky that every time he or she invested, it was actually the 52-week high. Now, you might think that these are examples where you invested at highs. What if you invested at lows? So let's assume there is someone, let's call this person Bhagyashali, very, very fortunate. Whenever this person has invested in the market at any given point in time, that was the 52-week low of the year. So you're investing every year at the lowest point of the market in that year, and you did that for again the last 25 years, the returns would have been on a compounded basis something like 15.1%. So the unluckiest investor is probably at 11 point something. The luckiest is about 15 point something. These are two extremes. Most of us, when we invest, will probably pick some random dates in between, not the 52-week high, not the 52-week low. Some of the investments could go at 52-week high low, but most of our investment will be staggered. So let's say you're doing an SIP, every month you're investing, then in most likelihood your returns would have been in this 12, 13, 14% kind of compounded rate of return, which by the way is a very high rate of return. Because if you think that by being in the market full time, by doing something hardcore research, you can earn much, much more, to be honest, it is not that easy, because even full-time fund managers with their research teams, etc., a 15-20 years compounded rate of return is more like 20-21%. You can still make 14-15% by being a passive investor, considering the data for the last 25 years. I have to obviously add that previous returns is not what you may necessarily see in the future, but the limited point I'm trying to make is, do not try to time the market too much. Do not try to be over concerned about when is the right time. Just keep on investing when you have money. Keep on accumulating equity, and the way the markets behave is that over a period of time when it goes up, it will essentially take everybody up and your returns will be positive.